when we look at a crisis in China, we should understand that China is, even though it's a huge manufacturing economy, it's a tiny economy as far as world financial markets are concerned. And the reason for that is it doesn't have a fully tradable currency in the same way that in the same way the Australian dollar is. And as I pointed out last year, it's one of the results of that, its participation in the global capital markets is only slightly larger than Australia, so it's tiny. And it's around about, if you compare the size of the US capital market, the international capital market, to the Chinese capital market, the US capital market is around 30 times as large in terms of its international effect as is the Chinese capital market. So though very, very major things can happen in the Chinese economy, they don't have the same effect on financial markets as if the same things happened in the US economy. And when we're in a situation, as I'll start to talk about the data for China, where the data in China is really very bad. But on the same token, the data for the US is really very good. And I think in the medium term at least, we're going to be saved by the fact that the US data is good, even though China is looking pretty weak. The outlook for the Chinese economy this year, if this hadn't happened, can be gauged by looking at the International Monetary Fund forecast that was issued in the middle of January, in which growth was expected to be about 6%. That was before the impact of the coronavirus. Last week, the OECD put out a forecast of 4.9% growth for the full year. And in my quarterly, I'm even more pessimistic. I think the growth rate will be 4.2% this year, 5.7% next year. The reason I'm so pessimistic is that the numbers for February, as reflected in the PMIs, and we actually model the PMIs and the effect on the Chinese economy, are truly terrible. It suggests that around about 7% of the Chinese economy was shut down for the month. Now, if that kind of result continued through the year, you'd have the worst result that China has had probably since the Great Depression in the 1930s. But what the scenario that the OECD has and the IMF now has and I have is that from a very low point at the beginning of the year, you gradually recover through the year, and that recovery happens for either of two reasons. Either the virus is finished and dealt with, or they just have to put up with it and get the economy back in shape. Because if you left an economy in this stage of shutdown for an extended period, you would have the most enormous current account crisis in China, which I don't think they can tolerate. So I think what's going to happen is you go through the year and you have a gradual increase in the output, particularly of government-owned enterprises, and particularly the large government-owned enterprises such as coal, oil and steel would recover first. And I think that's positive for us, but we have to see the data coming through. I'd like to point out that when the actual industrial data comes out for February, it will be a very bad number, and I think it will have further downward effect on markets. However, having given you all the bad news about China, again, if you look at the quarterly institutional presentation, what you'll see is our model of US GDP shows it's knocking out solid 2% growth this quarter and solid 2% growth next quarter. And that's really important because, like I say, the US is far more important for financial markets than China is. Why did the market fall so fast? Well, particularly in Australia, it kind of helps that it was vastly overvalued to begin with. Not overvalued enough to generate an end of cycle bear market, but enough to generate a solid correction. Our current fair value for the ASX 200 is 65.48. That's probably about 50 points lower than it was when I last talked about this in January. And that means that the market peaked at about 650 points too high. Now, or yesterday, trading at 64.35, it was 113 points too cheap, but you'd expect it to go another couple of hundred points below that. The real problem is in the US market, where it also went 550 points too high, getting up to 33.93. Our fair value there is 28.46. And yesterday at 3,000 points, it was still 150 points too cheap. So the US, we need to come down a bit more, but the US has significant downward correction to go to. So the Fed is doing as I expected to support financial markets by cutting the Fed funds rate. The RBA has started that process, and that will support financial markets. But we've still got a bit more of this shock to take in terms of downward correction before I can give you extremely positive news, hopefully in a few weeks' time.